We're officially in a bear market, and the odds of us going into a recession have definitely increased. With inflation out of control, gas and food prices skyrocketing, and the stock market falling harder than Joe Biden on a bike, it's harder to figure out where you should be investing your money. So I made a list of 3 quality stocks that you can invest in during a bear market and during a recession. I'm using these same stocks in my clients' portfolios every single day. Make sure you watch through to the end of the video so you get the full analysis of each company. Let's start first with the legendary Coca-Cola. Coca-Cola Company has been in existence for over 135 years. They operate in over 200 countries and territories and have over 200 brands. Coca-Cola has a current price of $62.95, which is 6% away from its 52-week high. If you've been investing in this company for over a year, you're especially happy with the 16% return you've made, especially compared to the S&P 500, which is a dog. Coca-Cola is a very profitable company. Their gross margin is over 60%. And net income margin is almost 26%. That is refreshing. I know, cheesy joke, I'm sorry. One thing to note is that Coke has a forward price to earnings multiple of 25, which is a little bit higher than I'd like. But knowing that they have a dividend yield of almost 3%, that makes me feel pretty good. Coke is starting to develop a new product line which includes adult beverages. Their newest is Jack and Coke. It's nice to see an older company take on some newer challenges and branch out into the adult beverage industry. It shows that they're adapting to the times. Coke has a team of powerhouses backing them financially. Their top institutional holders include Berkshire Hathaway, Vanguard, BlackRock, State Street, and many more. These guys are powerhouses. While Coca-Cola Company isn't immune to a recession, they always seem to find themselves being put into portfolios whenever things are getting too choppy or pretty rough. I think their ability to adapt and evolve into new product lines and move with the times, as well as having very strong institutional backers, leads me to believe that this is a good investment for long-term investors even through a recession. Company number 2, Home Depot. Now, Home Depot is more of a contrarian play. That pretty much means you're doing the exact opposite of what the rest of the crowd is doing. When they're buying in, you're selling. When they're selling, you're buying in. In a recession, consumer discretionary spending is declining. That means companies like Home Depot are getting less sales. And when a company has less sales, that means their stock price usually goes down. And that's why I'm going to consistently be buying in as the stock price is going down. I want to buy this at a cheaper price. And I think the Home Depot is going to be around for a while. Home Depot was founded in the 70s, which means it's been through a few recessions and a few declines, including the 2008-2009 housing collapse, where Home Depot lost 47% of its value. Now that seems a little scary to be investing in a company where it's losing so much of their value. But if you believe that they are going to recover at some point and the US economy will recover at some point, then it's a great time to be entering into that stock. This management team has experience going through recessions and giant collapses, and I don't think this is any different. I would expect this management team to navigate through this same recession and work their way through to a successful ending. Now, if you bought into the company in 2008 and 2009 during that huge crash and kept it up until today, you would have over 1,000% return. Those are incredible rates of return. Now, past performance is not indicative of future results. We know that. But if you believe a company is going to get through this, then I think it's a good time to buy in when the prices are lower. That's why I would use any decline in their stock price as an opportunity to buy into it. You don't have to dump it all in at once, and you don't have to dollar cost average into it as well. It's something that you can plan strategically for. If you're not sure how to do that, click the link in the description below and we can set up a time to talk. Company number 3 is Chevron. Chevron is an energy company with a $290 billion market cap. This is a big player in the game. And when it comes to their profitability, Chevron does not disappoint. A key profitability metric in the energy sector is the cash flow from operations. Clearly, Chevron outperforms with $33 billion compared to the sector median of $375 million. It's a big difference. And that's probably why investment legend Warren Buffett himself has increased Berkshire Hathaway's holding in Chevron, making it the 4th largest holding. Now, when a company is extremely profitable, it doesn't necessarily mean that they have a large dividend. But with Chevron, theirs is pretty good. They have a payout ratio of over 50%. They've had 6 years of consistent dividend growth, with the current yield being about 4%. The energy sector has been extremely profitable the last year and a half, close to 2 years now. And because of massive underinvestment in the energy field for about a decade now, energy supply is lagging while the demand is increasing. And while it's an unfortunate time and nobody likes paying higher gas prices, the benefits for investors is that supply and demand issues actually can be a good opportunity to make a profit back. So if I'm spending a lot of money at the gas pump, I at least want to get that money back in an investment. With energy prices continuing to look pretty promising at this point, you have to keep in mind that these prices are volatile. This is a cyclical industry and prices can change fast. But hey, if Warren Buffett is putting billions of dollars on the line in this company, I'm comfortable taking a calculated risk in Chevron too. Now guys, one of the most important parts of investing is really controlling your risk. And one way of doing that is through diversification. And while diversification is no guarantee that you won't lose money or make a higher return, it's really one way to control risk and control the level of volatility that you're experiencing in the market. Reviewing the beta of a portfolio or reviewing the standard deviation of your stocks is one way that portfolio managers and advisors like myself help control that risk. We're in some very different times when it comes to investing compared to the last 10 years. So I encourage you to invest wisely, do your due diligence, do some research before diving into any stocks or companies. Make sure that you're well diversified. With so much volatility in the market right now, you want to be actively managing your portfolio, not just stuck in the mud in one area. It might be appropriate for you to be shifting from one sector to another as things evolve. So reviewing different risks, making sure that you're beating different benchmarks or at least staying in line with certain benchmarks that you have. You don't want to be investing and having huge losses. You want to have something that's matching your risk profile. So feel free to click the link in the description down below. If there's any way that I can help you out, I'm more than happy to. All right, guys, that's all I got for this week. I appreciate your time. Don't forget to like, share, and subscribe down below. Appreciate it, and I'll see you guys next week.